So this is session 6. The topic is Unleashing Asia's Wealth Potential, Navigating a New Era for Investors. And here I have 3 lovely speakers. To the right is Patrick Yip from Deloitte and Peter Stein from Private Wealth Management Association and Sam Abouzahr, and excuse me, and from HSBC. Thank you for your time to join this panel. We are going to talk about the role of Hong Kong as a prominent wealth hub in Asia. So we're trying to cover in the next 40 minutes 4 topics. The first topic is an overview of Hong Kong's competitive advantages in wealth management. So I'd like to invite Peter to answer my first question. And how has Hong Kong's wealth management sector performed in terms of growth and market size over the past 3 years? And obviously, we see the government has been promoting the growth and the development of the wealth management industry in the region. And what's the government policy to support all this? I think it's all linked. Over to you.
Thank you, Lily. So over the last 3 years, assets under management in the private wealth management sector in Hong Kong, that's the last 3 years where data is available. So this is the last year would be data that's valid as of end of 2021. So over the last 3 reported years, assets under management grew by 39%. So it's a pretty impressive amount of growth that we've seen in the sector. And if you look at data going back to 2016, compounded annual growth in the private wealth management sector is nearly 12%, 11.9%. So we have seen pretty consistent, rapid growth in this sector for the last 5 or 6 years at the very least. The last year where data was available, assets under management did decline by about 6%, but much of that was because of the decline in the markets overall. So it was really the value of the AUM that declined. There was still net new money coming into the industry, and this is despite COVID and all of the issues that were entailed as part of COVID. I would expect, we don't have the data yet for last year. I would expect that, we may see that the data was negatively impacted by the fact that we had closed borders, therefore difficulty in opening new accounts and bringing net new money into Hong Kong. Markets also had a rough year last year, so we'll see. But overall, the story has been incredibly positive. And if you look at the various measures that have been put in place by government and regulators to support the industry, I guess I would point to a few. On the talent development side, there's been support from the government in various programs to train up people to work in the wealth and asset management sector. There's something called the Wealth and Asset Management Pilot Program, which is funded by the Financial Services and Treasury Bureau. There's a program that we organized together with the Hong Kong Monetary Authority called the Apprenticeship Program for Private Wealth Management. And both of these programs train up people from the university to work in these sectors, give them opportunities, and they also provide for the WAM program that I mentioned earlier. They provide funding for people to get training in the wealth management sector. But I think more significantly, earlier this year, we saw a raft of measures that were announced by the government to support the family office sector. So that is probably the most significant series of initiatives that we've seen that are aimed at promoting Hong Kong as a private wealth management center.
Thank you, Peter. So you already touched on the regulatory. So my second question is relating to this, and I'd like to ask Patrick to answer this one, which is, how does Hong Kong's regulatory framework and investor protection measures contribute to its attractiveness and as a wealth management hub?
I would say from a regulatory perspective, as far as safety of your assets is concerned, Hong Kong is very good. Hong Kong, is very famous for its rule of law regime. It's been around for many, many years. We have excellent judges. We have an excellent, legal system. And in fact, I have never seen anything like if you put assets into a trust, it will be stolen by whoever, and it will not be returned. And because of some legal troubles, people would have foregone their assets in Hong Kong. There's no such thing like that. So I would say Hong Kong is very safe in this regard. And plus, we don't have any exchange controls. We don't have any foreign currency controls mechanisms. And our court system is very transparent. And you can take money out of Hong Kong and put money back into Hong Kong very easily. Okay, so from that perspective, in terms of mobility of capital, Hong Kong is really supreme. And so I would say under the one country, two systems environment, Hong Kong really stands out as a free port for both physical goods, but also financial capital. So from that perspective, I would say Hong Kong is really perfect for putting your money in here and safeguard it for the long haul. So that's my personal opinion.
Thanks for your personal opinion. I will just try to bring something up. It's your turn to answer. You cannot answer. Speaking of the safety of the client's capital, obviously we had a recent geopolitical situation where Swiss stepping to put all the sanctions against their Russian clients, some not really oligarch. And we have a lot of mainland Chinese clients throughout the lockdown is moving their capital cash flow into Singapore. So how do you interpret this in the future geopolitical situation? Sanction apply? Does Hong Kong stand in a very competitive status in this aspect?
Now, interesting question. I don't have a crystal ball. Okay, I don't know what's going to happen. But based on the Russian sanctions model, we can learn a few things from it, right? So if a big country like the US, if they were to impose any sanctions, likely all its friends, allies, would do the same. So now the question is, of the place that you just mentioned in Asia, whether it is a friend or a foe of the US. Now, if it is a friend, and if the unlikely event that the US is going to do anything drastic about China, would this friend be aligned with the US? So think about it. So if you are a Chinese resident or you still have a China passport, you're just residing in that location. So your nationality is China. So based on the Russian model, there's a possibility that this friend of the US would impose sanctions on your account situated in that particular location. However, in Hong Kong, China is not going to sanction us in Hong Kong, right? So these are our compatriots' money and wealth in Hong Kong, which is part of China. It would be silly to say Hong Kong is going to sanction the wealth of Chinese people. Well, that doesn't happen, right? And also from a lot of countries' perspective, they still respect the one country, two systems arrangement. So they may consider people in Hong Kong or even money put in Hong Kong is kind of different from money that is put in mainland China, for example. Okay, so I would say Hong Kong, from this perspective, it has the best of both worlds. It has the protection of the one country, two systems, and it has the protection of mainland China in case there is a unlikely event that some Western bloc that they're going to do something drastic about China, because you don't know who their friends are. Actually, we know. Okay, so you have to be careful. That's my advice.
Thank you. Would you like to add on, Sami, on this point? Or can we move on to the next question?
Happy to move on. I think you've covered it well, Patrick.
So, and how obviously HSBC, a very big universal bank, and I'd like to ask you, how does Hong Kong's robust financial infrastructure, including its banking system and capital markets, contribute to its competitive advantages in wealth management?
Yeah, this one's a bit more straightforward because clearly it does. So I think Hong Kong has an incredibly robust banking system, and it's been tested over the last 4 years. So we can say that with even more confidence, and that gives investors and clients a lot of confidence. If you look at the landscape, it's very heterogeneous. You have universal banks, pure play private banks. You've got insurance companies, asset management managers, public, private, trust companies. You have the whole gamut of financial services ecosystem there that's competitive across the segments and obviously adds to that strength. And then on the capital market side, it obviously has deep liquid capital markets that provide broad exposure. They're very accessible as well. And if you look in Asia, outside Japan, I mean, Hong Kong is the size of the capital market still multiples anywhere else. So I think those are really pillars that reinforce the strength of the financial system here. The regulatory regime that Peter already discussed, it's very engaged, it's principle and risk-based, it's progressive. Industry bodies are very active as well. So I think that ecosystem makes it very conducive to wealth management, in addition to the obvious strengths around that role of connectivity between mainland China and the rest of the world. I think from our perspective, dealing with clients, and we obviously are in the wealth management space in a lot of markets, I think the client base itself is a big strength, because this is definitely one of the more engaged, sophisticated client groups globally. People think a lot about what to do with their money, and they are demanding. And I think that creates innovation in the wealth management space, which benefits everyone.
Thank you, Sami. So when you mention a client base, and naturally move on to the next topic, which is when you're talking about Hong Kong, one of the closed topic coming up throughout the conversation today, including Eddie mentioned, is the cross-border wealth management between Hong Kong and the mainland China. So I'd like to move on to the next sector and to explore Hong Kong's role as a gateway for cross-border wealth management, including its connection with mainland China, the Great Bay Initiative, and the opportunities and the challenges in serving clients from both domestic and international markets. So I'd like to ask Peter. So obviously it's my first panel discussion with you. It's great to know PWMA. And as you know, you mentioned about talent. So in mainland China, many of the audience here are from mainland China today, and knows despite it's one country, it's two systems, the financial system are totally independent. So what does PWMA's role in engaging your members in this particular scheme and the program by promoting cross-border wealth management, the Chinese peer group, the international peer group through your association?
Well, thanks, Lily. So we represent international institutions that are global, regional, as well as local. And by local, I mean Hong Kong Chinese, as well as Chinese-owned institutions that are operating in Hong Kong. And the one thing that they all have in common is that they have a presence here in Hong Kong. They're doing business with clients here in Hong Kong. And many of their clients are local, but many of their clients are also from across the border. There's a very large portion of clients who are from the mainland, who have assets outside of the mainland and want them to be managed properly. And so Hong Kong has this role as an international financial center that can provide private wealth management advice at a global standard while still being part of China, which is really a completely unique situation. One of the things that makes Hong Kong particularly effective is in that capacity is that it has this special relationship which is manifested through the Connect schemes. So we have Stock Connect, which has become hugely successful at channeling overseas capital into the mainland markets and mainland capital into the Hong Kong markets. We have Bond Connect, which is doing the same for the debt markets. We now have Wealth Connect, which is a nascent program that is, hopefully, I think in the future going to play a more important role in channeling capital into wealth management products on both sides of the border. And now we also have ETF Connect and Swap Connect, and all of these Connect programs are an important channel for bringing capital in both directions, and they really highlight what makes Hong Kong distinctive as a global wealth management center.
That's very good, because you brought up the stock bond wealth ETF Connect, which was quoted by Eddie during his speech today. And I'd like to bring the next question to Sami, as the HSBC has bigger presence, not just in Asia, in Europe and in Middle East. So my next question is, what role does HSBC play in facilitating those kind of cross-border wealth management services and investment flows between mainland China and the rest of the world? Because when we talk about the Connect, we have the Shanghai-London Connect, Shanghai-Hong Kong-London Connect, and soon I heard there will be Zurich-Shanghai Connect. So obviously the big bank, universal banks will be a big beneficiary and a big key player to facilitate that, to help their wealth managers and wealth clients to reach to the outside, the next step. So I'd like to hear your thoughts.
Yeah, and connecting Asia with the world, and particularly China through Hong Kong, that's core to HSBC's purpose, and it's what we've always been doing. So there's no doubt that many of our clients, be they on the corporate side or on the private banking side or even on the retail wealth management side, are with us because they expect that connectivity, and they know that we are very much embedded in the region, in Hong Kong, in mainland China. So there's really probably very few relationships that HSBC has that don't involve that conversation. And obviously we facilitate that in many ways, but specifically on the wealth management side, we're going to be riding on some of those institutional frameworks. But even without that, I think the connectivity of investment is there, whether it's through family offices, whether it's through even just the product set that we provide to investors here to access broader global exposure. It's very much a part of what we do, and I think it'll only become more of a focus for us over time.
Patrick, obviously, I'm always giving you quite tricky questions. The next one is, is there any specific challenges or considerations that arise when providing those wealth management services to clients with cross-border interests in both Hong Kong and mainland China?
Now, first of all, the biggest number one challenge is that the RMB is not fully convertible yet. So sometimes for very wealthy Chinese clients, they have a lot of RMB, but they really want to try out foreign investments. So it may not be that easy. So thankfully, because we have the Connect programs, we have banks like HSBC, they have a lot of products in China that will take RMB. And then they would then do through the ODI programs or whatever programs, then they'll be able to invest overseas, right? So how to make efficient use of RMB and also foreign currency? No, the other way, foreign currency from outside of China to get into China may not be that easy either, okay? So So somehow we need to find a way to make life easier, hopefully, for these cross-border investors. So secondly is about the fact that these are two different systems, tax systems and legal systems that we have. So a lot of investors from China, they are still under the impression that if I go out to Hong Kong or to the West to invest, it's still the same way, right? So, and then I ask these clients, what do you mean by the same way? Oh, if I don't report, then there's no tax, right? So that is the impression that a lot of clients that they have. Because in China, probably sometimes they don't think that they need to report anything, and therefore there's no need to pay tax. However, that changed as a result of CRS. We all know what CRS is, right? We should know, because when you go to open a bank account, they will now ask you what your tax residence is. So imagine a Chinese investor that has an account in Hong Kong, let's say with HSBC. I'm sure the first thing you ask is, what is your tax residence? So if say China, then that account's information will be reported back to China. Then the Chinese tax authorities, and then we see this information, then they will say, Mr. So-and-so, we know that you have a BVI company out there that has a lot of cash in HSBC. So can you explain that? What is that? Okay. So they didn't realize under Chinese law, the fact that you own a BVI company, that BVI company, now I'm not singling out BVI, okay? I'm not singling out BVI. It could be Cayman, could be any company that doesn't pay tax locally. That income could be subject to tax in China currently. That means that company doesn't have to pay a dividend back to the individual. That income will be subject to tax in China right away. So a lot of Chinese clients don't know that. They thought it's in the BVI company, so I don't need to worry about it. I will use that money when I come to Hong Kong. Okay, I'll spend all that money, but they don't realize because of CRS that will be reported back to China. So they are actually being exposed without even knowing it. So in terms of how to help these clients is that first of all, they need to help them understand they have a legal obligation to comply with the law. And then whatever planning that they do, they should do it within the confines of the law, right? And there, of course, there are a lot of legitimate, conventional planning ideas around these structures. But it's not like, oh, I don't need to report, then therefore I don't have to pay tax. So it's not like that. So it's a matter of educating them, I would say.
Yeah, and I think if you look at the Wealth Management Connect, that also highlights some of the challenges. I mean, ultimately, we're not providing cross-border advisory in this model, and they are different regulatory systems. What someone can talk about in relation to Hong Kong products when they're sitting in Shenzhen or vice versa is limited. So that's still very much an evolution. And I think we're seeing those challenges in the implementation of Wealth Management Connect. At the same time, you've got a foundation to build on. There's 2.0 probably coming, but it does highlight, in addition to what you were mentioning around source of wealth and tax, there are a number of challenges we still have to navigate.
It's a very complicated world, I must say, because when you do the mainland China, you cannot cross-sell, and they have their own regime, while the clients have a much more diversified needs beyond the mainland China, which naturally brought to the next topic is the Family Office initiative is launched by the Hong Kong government to build Hong Kong as one of the global family office hubs. So that could be part of the solution, but won't be solve all the problems. So I'd like to ask Peter, in your view, what specific measures has the Hong Kong government or initiatives the Hong Kong government has implemented to promote the establishment and growth of family offices in the region?
Thanks, Lily. So I mentioned earlier that the Hong Kong government announced a series of initiatives aimed at promoting the family office sector. So that was in March of this year. And those initiatives included a tax incentive, which has now come into effect and is eligible for the tax year that ended this past March, and basically means that family offices which meet the criteria to be eligible for this program do not need to pay any taxes on the gains they make through their investments. It makes Hong Kong incredibly competitive as a family office center. The other initiatives include a plan to beef up a liaison office, which has already been set up by the government to work specifically with family offices that are interested in setting up here and sort of help them navigate all the various things that they need to deal with in terms of setting up, getting licenses if need be, just establishing their business, finding people to work in the business. More importantly, they are introducing a capital investment in entrance scheme, which will allow people to get residency in Hong Kong if they invest a certain amount. And that is something that we had in the past, but is now being reintroduced, and which will make it easier for people to move here if they have the capital to invest. There's a plan to look at setting up an art storage facility at the Hong Kong airport. There's also plans to set up something called the Academy for Wealth Legacy, which will provide courses and training for people related to family offices and wealth management. All of these things together, make up a pretty impressive list of initiatives, and just combined with the fact that even before then, Hong Kong had a pretty impressive set of characteristics that make it appealing to family offices. I mean, we talk about Hong Kong in comparison to our neighbor to the south, Singapore, which has been fairly successful in recent years in attracting family offices. And if you talk to people in the industry, many will tell you that actually a lot of the same things that Singapore has to offer were already on offer in Hong Kong. Where Singapore was different is that Singapore maybe was a bit more effective at marketing itself to family offices. And Hong Kong, being sort of a place that comes from a history of a more laissez-faire approach to markets, did not take a proactive stance in going out to market itself. I think now that's changing, which I think is a good thing. These measures definitely improve on what was already a pretty positive foundation. So I expect to see that the market will respond pretty positively.
Thank you, Peter. You brought up Singapore. And obviously, 2019, when I was running my private banking Asia conference and my previous company, Singapore government just launched an initiative to build a family office hub. And they declared probably 20 family offices in that year. Throughout the lockdown, our first OMFIF Asia event took place December last year in Hong Kong, and they declared 700 and probably now 2,000 family offices. So I'd like to ask you, maybe Sami, is there a real rivalry or more interpreted as a collaborative effort? For example, you have a mainland Chinese client coming to you saying, I'm thinking of set up a family office, maybe in Hong Kong, maybe in Singapore. What's your approach?
Sorry, before Sami answers, I just want to challenge those numbers a little bit, because we've seen these numbers appear in the press quite a lot. 700 family offices, 1,000, 1,500 family offices. And I think it's important to understand where the data is actually coming from. And it's almost certainly coming from the number of families that have registered to receive certain benefits in Singapore, such as the 13X, the 13O schemes. And in order to qualify for these schemes, you need to have a certain amount of money. In the past, it was as low as 20 million Singapore dollars. Now I believe it's 50 million Singapore dollars. And if you talk to people who work with family offices, they will tell you that is not enough money to really run a family office. Family offices typically are not economically feasible unless you're managing somewhere on the order of maybe 500 million US dollars. So a lot of these family offices that are being counted are probably really families that qualify for certain incentives, just to throw that out there.
There's a very broad spectrum of what you'd call a family office. So yeah, I agree. Well, first thing, I think a little healthy competition is good. So we've obviously seen Hong Kong already building on a strong foundation, stepping up, and I think the measures you mentioned are going to be welcome. So, from our perspective, that's no bad thing. Everyone is competing to attract wealth and attract clients and create the best environment possible. At the same time, for us, for ultra high net worth clients, for family offices, having a client sitting both in Hong Kong and booking in Singapore or vice versa is nothing new. And it's quite an established model. And I would say it hasn't even really changed that much in terms of where money is being booked over the past few years. So we will have a lot of family offices who want to establish here, but they may also, maybe they have an external asset manager they own, and they might have some investments booked in Singapore, and we have family offices in Singapore who want to access Hong Kong as well. And we've got an established model of coordinating that, both in terms of the relationship management, the clients, the booking, even how we track and model and incentivize internally to make sure that we're offering clients what they need. So I think from our perspective, it is more collaborative. But obviously between the two centers, there'll be a degree of healthy rivalry, as I say.
Marketing campaigns, the budget. Patrick, would you like to add on?
Oh, just to do some advertising. This morning, just right outside, I did a live interview with Bloomberg on precisely this topic. Now, if you go on Bloomberg, you can search my name, right? And then you'll see that the topic is on Deloitte China, Yip, my last name Yips, on geopolitical tensions. No, don't believe that, okay? It's not really the main topic. It did talk about, they did ask me some tricky questions, about SOEs and Big Four, things like that. But I think I answered them, in a politically correct way. So you just need to listen to the rest of the interview. So basically what I said is this, because I was also part of the consultation process as far as the HKMA was concerned in drafting the legislation. I would say this, I really admire Singapore for its energy, okay? But you need to know where we are, Hong Kong, in terms of where our foundation, what our foundation is and what we are like. Now, the last I checked, Hong Kong's capital market in terms of capitalization is 32 trillion. Singapore, guess how much? 8 billion. So if you don't know how many zeros are in a trillion and how many zeros are in a billion, you go back. It's really hard on the calculator, but I can tell you it's 4,000 times. Hong Kong is 4,000 times that of Singapore. Okay, so now the Singapore 13U and 13O, they require you to invest 10% of the family office wealth, or 10 million Singapore dollars, whichever is less, in local Singapore stocks and securities. Now, can you find in the market only close to 8 billion? Can you find that 10%? If you have a 500 million, now, of course, you can do 10 million Singapore dollars. Versus Hong Kong, we have a very wide and deep capital market. However, our regime does not require you to invest anything in Hong Kong. So this pot of money can be in the air everywhere. The important thing is for the family office in Hong Kong to manage it. Now, talking about rivalry, at the beginning, we said the family office in Hong Kong has to manage this pot of money in a way that the pot of money is centrally managed and controlled by this office in Hong Kong. Later on, we are Hong Kong, right? We're being generous and nice. So we change that centrally to normally. So what does that mean? That means you can have a Singapore family office that will also manage to control that same pot of money, and Hong Kong will have another family office that will do the same. But we just say normally. You can do whatever you want in Singapore, but we just say normally, we are relaxed. Then you will qualify. So what it also means is that if your individual employees in the Hong Kong family office, they don't have to be in Hong Kong all the time. So it can be your cousins in China. They can come and travel to Hong Kong and do some managing of the parliament, as long as it's normal enough. Okay, so nowadays a lot of people are abnormal, but I think it's easy to make them normal. Okay, if they can come, often, frequently, a few weeks here and few weeks there, that should be okay. So what this also means is this: if they can get an employment visa to come to Hong Kong, what happens after 7 years? They become a Hong Kong PR. Now, look at what Singapore is doing. They said, if you do all this, we'll give you PR and then citizenship. But look at what is happening right now. Is that, hey, you have just met the minimum requirements. It's at our discretion whether we give it to you or not. Or if you qualified, hey, please get in line. Or there's 1,000 people there. Okay, so take a number. But Hong Kong, we're different. Because we're big, okay? We need a lot of people. See, we just recently approved like 50,000 to 60,000 new applicants for whatever these programs, right? These very high talent or whatever talent programs that they will come to Hong Kong. And I was told the Hong Kong immigration, they said specifically, they did not say specifically, they really want to support this program. Therefore, if you are, based on what we have heard, you can say it's grapevine, is that if you are working for a family office and you qualify as one of those immigration programs, hey, there's another line for you. That line is much shorter. Okay, so that's the way that we are being very practical. So talking about rivalry here, I would say not really rivalry. I mean, if I'm a PhD student, I wouldn't fight with a primary school student, right? I mean, no, I don't mean to refer to any particular cities here. I'm just saying that our capital market is so huge and so deep, and I'm sure other places they have their great things going for them and good for them. But I think we should be confident. Hong Kong, we have a lot going for us, and then we just need to do our best. Just like Peter said, we need to do a better job in telling people what we can do and what we can offer. Otherwise people do not understand, right? So it's like you're going into a restaurant. You thought always on offer is the appetizer. Actually, it's the whole buffet. People do not know. Okay, so we need to advertise that a bit better, right? So that's my view. I think Hong Kong's family office regime is poised to succeed. That's my view. And that's what I said in this morning's interview as well. So the interview was supposed to be 5 minutes. Then they talked to me for 12 minutes. And then they said, Patrick, we need to invite you back to our studio to have a more thorough discussion on this. Okay, so I think Hong Kong is going to win. That's the way I see it.
Thank you, Patrick. Thanks for your speech. So we're running out of time. So I'll quickly wrap up the last topic and about the market outlook and overview. I'd like Sami to answer. Just give us some thoughts to talk about your view and your thoughts on Hong Kong in the future on the wealth sector horizon. Obviously, you can talk about your initiative like technological innovation, artificial intelligence. It's a big topic, but we haven't covered today. But we probably have 2-3 minutes left, so I'd like you to lead the conclusion.
Okay, that's a broad ask. Look, there's 127 trillion of assets, wealth assets in Asia, growing probably faster than anywhere else in the world. We know that there's a BCG report talking about Hong Kong overtaking Switzerland as the world's largest offshore center. We also know, linking into your technology question, that there's a couple $1 trillion of assets that are passing from one generation to the next over the next 20 years. So we've got a lot of wealth. We've got still a lot of growth, very strong foundation, advantages that I think no other city can replicate certainly easily. And Patrick, I think, gave us a good summary of that. I'm not PhD or not. So I think there's still, if you look over the last 4 years, not much more could have gone wrong. I mean, the challenges that we've been through, and Peter mentioned still growing. We see it as well. Client growth, net new assets, the wealth business has continued to grow through everything that we've been through. So I think that's a lot of cause for optimism, but clearly not complacency. And the great thing is that I think everybody here is aware that we've got to do a lot. We've got to do more, not just talking about what we're good at, but strengthening and finding the areas where we need to do more. I think if you look at some of the initiatives that Peter mentioned, how we work with sophisticated investors, you're spearheading a lot of work in that space, how we balance investor protection with meeting client experience expectations as well. Looking at virtual assets, and the Hong Kong government's been very positive and engaged in that area as well. Whether it's sustainability, GBA, there are so many areas where there's a lot of activity, a lot of positivity, and clearly no longer any complacence. And everyone, and I think that's very exciting. We didn't get a chance to talk about technology, but wealth management is a technology business now. We obviously cover clients who are just starting out with their first investment, all the way up to family office. And so that presents different challenges, but it's a technological and a value proposition challenge, how we provide easy access to clients to wealth management, and how we enable the very bespoke, sophisticated, complex model at the higher end. That's something that we've invested a lot in, we all have to continue to do. And it needs the support of the wealth ecosystem, the regulators in Hong Kong to really make that effective. So a lot of optimism.
Thank you. Peter?
I'm going to keep it really simple because we put out a white paper in March of this year that we worked on together with a research arm of Tsinghua University called Hong Kong 2035, a global wealth management hub. And that paper lays out a number of proposals at how Hong Kong should continue to develop as a private wealth management hub that services the Greater Bay Area, that services China as a whole, and that continues to thrive as a global wealth management center. There's a number of specific proposals around how we can further develop the Wealth Management Connect scheme and expand that, developing a framework for cross-border advisory services in private wealth management, which would really help further cement Hong Kong's unique position with regard to servicing mainland Chinese clients, and a number of other ideas, including in the fintech space and in talent development. So please, if you are interested, go take a look at our website, pwma.org, and you can download a copy of the report.
Thank you, Peter. Patrick, 3 sentences.
I fully agree with what they said, and I just wish all of you a good future in terms of planning your wealth allocation and all the structuring that you need. And we are always here to help. This is what Deloitte does. The most important thing, the last sentence. Okay, so come talk to us if you need our help.
Thank you. That's a very lively discussion. We're running out of time, so I'm not running the Q&A session, but the gentlemen, I hope you will stay a bit longer. Do join the drink later on, and you can speak to all the audience and let them get to know your institutions more. Thank you.
Thank you.
Thank you.